Okay, this question, let me see first. Stella is a sole trader who sells on credit. She maintained a provision for doubtful debt 4%. This is a last year and this is a end year. This is a opening. This is a closing. We need to calculate 4% equal to how much? So times 4 times 4. Okay, this one is 3,000. This one is 37. So this is 3,880. This is a balance brought down. This is a balance CD. They ask for the prepare the provision for doubtful debt for the year ended 31st December 2022. Balance the account and bring down to the next year. Let's see the information. Okay, we have 2022. Beginning of the year is January 1st. Balance brought down. And this amount is 3,000, which is from here. Okay. And then end of the year, we have 2022, December 31st, balance CD, and the amount is 3080. So the differences had to transfer to the income statement. Debit more than the credit means that our income statement amount should be in the credit side. So December 31st, income statement 80. So this is what we get for the provision for doubtful debt. So transfer to the next year, January 1st, balance BD 3080. So this is for the provision for doubtful debt. Stick to reason why Stella maintained a provision for doubtful debt. Under the accounting principle, which is that we need to do provision is prudence principle. So under the prudence principle saying that we need to make sure profit and the asset not to overstate. So the reason for this one, the first is the prudence principle, which is do not overstate the profit and asset. The asset here is referred to the trade receivable. Another one, which is the matching principle. Under the matching principle, this to ensure the estimate loss of the debt deduct from revenue earned for the same period. So that when we charge as expenses, because this estimate loss is expenses, which is reduce the revenue earned. So there is a matching principle. Stella charged depreciation at 25% per annum using reducing balance method. She charged full year of depreciation in the year a vehicle purchased, not in the year of disposal. On 31st December, sold, this is end of the year, she sold the vehicle. And the vehicle has a cost of 16,000 when he bought on 2020. So means first year 2020, 2021, and in the year of disposal, no depreciation, means that 2022 don't calculate, only calculate these 2 years. So they want to calculate the gain or the loss. So first of all, we need to calculate how much the accumulated depreciation. So the depreciation for the first year is taking the cost 16,000 times 25% the depreciation. So we get 16,000 times 25%, which is a 4,000 first year. Second year, which is 16,000 minus the 4,000, because this one is reducing balance method. So I have to minus the accumulated depreciation and times 25%. So we have 12,000 times 25%, which is second year depreciation is 3,000. So these two add up equal to 7,000, the depreciation, accumulated depreciation. And our net book value equal to 16,000 minus 7,000, we get 9,000. So we compare with the disposal value, sale proceed disposal value. Disposal value is 9,005. So means that disposal more than the net book value. Therefore, we will get a profit on disposal. So the amount will be 9,005 minus 9,000. So we get profit 500. So this is the answer for the gain on the disposal. Okay, the balance on the Stella seed ledger account on the 1st Jan include the following: motor vehicle, provision for depreciation. Prepare the Stella motor vehicle account for the year ended 31st December 2022. So balance the account at 30 and bring down to the following year. Because this one is the beginning of the year, that means we have to take notes about the disposal asset. So let's put back the information. This is the information for the disposal. The beginning of the year, we put in the cost of the asset first, 2022, January 1st, balance brought down. And this is the beginning amount, 48,000. And we have a disposal asset, which is 16,000 the cost. So which is appear on the December, end of the year, 31st. This one is a disposal account. So amount is 16,000. Okay. And then we don't have any new asset purchased. So means that our balance CD will be 48,000 minus 16,000, 48 minus 16. So we get 32,000. So the asset balance 32,000. Subtotal. And then balance CD, balance BD, transfer to the January 1st. Balance BD, 32,000. Okay, the next is that we are asked to prepare the provision for depreciation. So we have the beginning year. Beginning year depreciation is 21,000. So we put in the opening first, 2022, January 1st, balance brought down, 21,000. And the amount for the disposal, this one 7,000. So 2022, December 31st, disposal, which is the amount is 7,000, this amount. And then for the current year, okay, for the current year, we need to calculate the income statement amount, the depreciation for the current year. So how are we going to calculate this current year? We have the asset balance, which is 32,000. So for this calculation, let me show how to calculate the income statement amount. Okay, our income statement amount, which is depreciation. Okay, the income statement amount is, let's check what is the income statement for the depreciation. Our cost balance is 32,000. This is a cost for the asset. And based on the current year, after disposal, from 21,000 after taking out this one, how much the balance of the accumulated? So we minus. So we will get 32,000 minus 21 minus 7, we get 14,000. So this 14,000, you have to calculate 25% for the current year depreciation. So we take 32,000 minus 14,000, which is 18,000. 18,000 times 25%. So we will get 4,005. So the amount to charge as a depreciation for the income statement is 4,005. Okay, so the balance CD will be total, this one, 21 plus this one, 21,000 plus 4,005, which is 25,500. 25,500. And take 25,500 minus 7,000. So we will get 18,500. So bring it to here, 2023, January 1st, balance, write down. And the amount is 18,500 in the correct box to show the indicate whether it's a capital expenditure or revenue expenditure. Capital expenditure is a purchase of the non-current asset or extension of the non-current asset. Whereas revenue expenditure, the extension of the premises normally refer to the capital expenditure, but not all the item is capital expenditure. Capital expenditure is the money spent on non-current asset, whether you purchase new non-current asset or extension of the non-current asset or improvement of the non-current asset. That is called capital expenditure. Revenue expenditure is referred to the day-to-day expenses that you pay for. So legal fee for obtain permission to build. So when this is a one-time cost, this is a one-time cost when you need to build the extension. This type of cost only one time incurred is capital expenditure. Building costs for the extension. So this one, you build, you need the money, then these are capital expenses. Insurance for the office. Insurance, something that you need to pay every year. Something need to pay more than one time. This is a revenue expenditure. Painting of the new office. This is a new office extended. So this paint is first time you incurred. So this is also capital expenditure. Calendar, every year you're going to print. So revenue expenditure. Purchase of the office equipment. This one, you buy new asset. You get people install your office equipment, also one-time cost incurred. Stationery is something you need to buy whenever you finish to use it. There is a revenue expenditure. So this is the answer for the second question for the year 21, May, June 23.